Hi everyone, Simon Barwick here from Bentleys Wealth Victoria. Hope you're well. I'm here today to present our March portfolio and market update. Firstly, this is general advice, so if you do have a question, please speak to your advisor. We've got a broader range of topics to discuss today simply because there is a lot going on. So I'll firstly cover the market summary from February. So Australian equities actually had a fairly good month. The S&P ASX Ordinaries was actually up 3.34%. And this was supported by solid reporting from both the materials and banking sector. And this was despite increased volatility due to the previous RBA announcement of a rise in the cash rate. However, US sort of returns on equities actually lagged. They were down 0.76% in US dollar terms. And this was because investors were rotating away from mega cap stocks and moved towards more cyclical and value sectors. By contrast, emerging markets actually rose by 5.1% in US dollar terms. Interest rates also diverged depending on the region that you're in. The RBA lifted our cash rate by 25 basis points to 3.85%, and that's the first rise in over 2 years. The US 10-year Treasury yield, however, fell 25 basis points to 3.96%. And the reason for this is it really reflects softer growth data and more of a safe haven demand. If we look ahead, and if we consider global growth, we do believe it's going to remain positive, but it is quite fragile. There are geopolitical risks, tariffs, and diverging central bank policies, which are likely to keep sort of markets volatile. We believe that diversification and earnings quality will remain key themes going forward to drive returns. I wanted to touch today also on the geopolitical risk which we're seeing currently in the Middle East. The US launched Operation Epic Fury, and on that announcement, the market reacted with a risk-off response, and markets fell more broadly. However, oil prices surged, and as did the gold price, which increased by 3%. What I wanted to cover today is more on the historical precedent, what has happened previously to markets once we've had this sort of conflict. And so what we've seen is these sort of conflicts and these conflicts are often short-lived. And what we mean by that is we've seen this previously where there is clear US military superiority, which there is in this case. And we've seen that the equities will recover once the scope of the conflict is defined. Now, we're not at that point yet, and this is really why we're seeing continued uncertainty and volatility in markets. This is where 20% of the global oil flows, and although Iran only accounts for 4 to 5% of global oil production, any prolonged disruption will materially affect sort of the oil prices, which then flows into inflation and growth expectations. For Australian investors, the ASX does have a heavy weighting towards energy and materials, which can provide a partial hedge. However, financials and technology may come under sort of more short-term pressure during these periods of heightened uncertainty. Finally, I wanted to cover a little bit on gold and sort of look at sort of its strategic diversification theme. In 2025, gold delivered an exceptional return, 64%, which is its highest return, since 1979. And this was despite a sharp pullback in January 2026. Central banks' demand has really been the key driver. And this is where we've seen the share of global reserves increasing from about 9% in 2022 up to about 18.2% by December 2025. And this has been really led by emerging market buyers who have been seeking diversification out of US dollar holdings. So the lower yields and fiscal concerns have supported the gold role. And in sort of in central bank holdings. And so where we've seen falling bond yields, higher sovereign debt, and de-dollarization trends, this has reduced the opportunity cost of holding non-yielding assets like gold, and so central banks have increased their holdings accordingly. From a portfolio perspective, gold continues to show a low to negative correlation to equities, including the ASX 200 and S&P 500. So this is reinforcing its role as a long-term diversifier rather than a short-term trade, which is speculation and carries a lot of risk. So from our portfolio perspective, we do have indirect holdings in gold, but we'll continue to monitor this asset class closely. Thanks again for joining us this month. We look forward to assisting you going forward, and please contact us with any questions. Thanks a lot.